Afternoon, everyone. We're here today with Chris from CoreShares, and we're going to just be chatting about the second principle, which is keep more returns for yourself, which is obviously looking at the costs and how you would look to compare costs of your various investment products. So, Chris, I don't know if I can jump over to you quickly. You can just do a quick high-level overview of this, and we can take it from there.
Sure. Thanks, Brian, and thanks to the Easy Equities guys for hosting us again. As we mentioned earlier, we're going to be chatting about what we call the core principle number 2, and it's again very simple, and it's keep more returns for yourself. Effectively, what we're saying is that you shouldn't be paying away some of your returns. Sorry, okay, we're scrolling through. There we go. So keep more returns for yourself. Really, one of the benefits of exchange-traded funds and of investing outside of the active management world is that you save significant costs in terms of the actual fees that the funds are charging. So I'm not sure if you're all familiar with how fees are charged, but what happens is the fund will accrue income over a period. So that income is in the form of dividends that are paid into the fund or interest and such. And then at the end, before you as a client get paid out that income, the fund manager will take that fee. So in other words, your income that you should have received has already been deducted a fee off it. And so why it's important is because once that fee is deducted, the ability to reinvest it and compound it obviously not an option for you. So here's just a little graph where you can see the significant difference in the fees between passive or ETFs and active funds. So here we've got the average global general equity fund. So the average fund investing offshore in South Africa is at a fee of 2%, and the CoreShares S&P 500 is at a fee of 0.55%. So you've got close to a 1.5% fee differential. And really why it's important is because the impact of that fee differential compounded over time can be significant for you as an investor and significant in terms of the finishing or the closing valuation of your investment. That example is in the global world. In the local context, the average general equity fund is 1.57%, and the CoreShares S&P Top 50 is 0.32%. So again, over a 1% fee differential. What we talk about sometimes in the passive world, and we talk about in the asset management world, is it's called the structural alpha. So in other words, the active manager now has to outperform the passive strategy by 1.5% or over 1% in the local context every year consistently, just to match the index. And that's why, and I'm going to scroll forward quickly here, and that's one of the major contributions why active managers really struggle to outperform indices. You can see here that over 5 years, 77% of active managers actually underperform this the index. And now what's amazing with asset management is that you are, as an investor, effectively paying them this fee without the guarantee of good returns. So you're taking a lot of risk that you're going to pay 2% a year, but that guy's actually going to underperform the index. So we call that manager risk. But really the principle here is that the compound of costs over long periods of time are significant. So we ran a very basic little case study. We said, let's say you had an active manager and you had an ETF. The active manager's annual fee was 1.3%, and the passive or ETF fee was 0.3%. So a 1% differential, not dissimilar to what we have in actuality in the market. In fact, we've been relatively generous in terms of giving the active managers a tighter differential. And then let's assume that we get a return of 13% a year in each of these strategies, so equal return, which, by the way, we will see that active managers who return in line with the index are actually few and far between. So you're taking a risk that guys will actually produce the same return as the index. And then let's just say you have an initial lump sum of 100,000 Rand. And let's have a look at the impact of 1% fee differential. As I mentioned, that 1% is actually lower than what the fee differential is in reality. And this is the outcome. So now you've got an active manager who has performed well, at least in my opinion, very well. He's performed in line with the index. So he's a top quartile active manager, but he's taken his fee of 1.3% a year. And then you've got the passive manager who's produced index less 0.3%, which is his fee. And this is the outcome, which over a 30-year period is very significant. It's close to R1 million difference in finishing capital, which is a lot of money considering your ending value is at the top end 3.6 million and at the bottom end 2.7. It's close to, in fact, 40% of your ending value in the active scenario. So that's the impact of costs and how costs erode returns over time. Now, what's really important here is if you look at the graph, it's kind of like Maths 101, but it's the effect of compound, and it's the effect of that annual compounding costs. Years 1 through 11, there's really not much difference in the return profiles. But as you move from years like 10 and north, the difference is significantly greater, where low-cost investment has significant benefits going forward. This is just that Spiva graph where even though the costs are much more, you actually have a lower chance of outperforming the index or the ETF over most time periods. So really, it's as simple as that. Core principle number 2 is keep more returns for yourself. Investors, as I was mentioning earlier, what's interesting about asset management is that investors agree to pay a fee without knowing what will be delivered. It's kind of like agreeing to pay for a really expensive car, and you're only going to find out what car you're going to get in 30 years, and it turns out to be one of the cheapest cars in the market, which is an unusual scenario in asset management. Another bullet point is that not only is this fee differential significant in terms of the ending value of your investment, but at the beginning of your investment, what's very interesting is that Morningstar, the local Morningstar office, who's an analyst team, a global analyst team actually, but also with local presence, they have done research to say that the best way of establishing which fund will have the best future return is actually looking at their costs. So the funds with the lowest TERs have the highest chance of relative success, which is amazing. So you can analyze the investment team all you want, their philosophy, so on and so forth, but what you should be honing in on as a significant portion is the fee. And now with passive or with ETFs, that's a key value proposition of the strategy. So that's really as simple as it is. That's our core principle number 2. The first was keeping it simple is smart. And number 2, or at least number 1 is that, and number 2 is keeping more returns for yourself. We will do another one with the third principle, but just to end with this quote, William Sharpe, who's a Nobel Prize winner in economics, says, this is a quote of his saying that a person saving for retirement with a low-cost investment could have a standard of living in retirement that's 20% higher than that of a comparable investor in high-cost investment. So quite a significant quote from William Sharpe. Now I think, like we did in the last webinar, we're going to be taking some questions, and please fire away with any questions you have, whether it be about investments. Brian can answer some questions. I'll jump in and answer questions where I can. But really, it's over to you as the floor, and let's make this as interactive as possible to get the most value out for you as the investor.
Perfect. Thanks, Chris. So, I mean, before we go on, I think that does highlight a huge point between the active and passive debate, where, especially when you're looking at longer-term goals, you're definitely looking at minimizing your costs as much as possible. Something that is a hidden cost that a lot of us don't think about when we're doing these sorts of things is also tax. So your capital gains tax or tax on interest that you've earned. I think that is something that should be highlighted. A lot of these ETFs are available in your tax-free savings, where obviously if you can afford to save that maximum benefit in the long run, it is definitely going to help you out from that cost perspective, and even increase further those gains that you will be actually able to receive. I think the other question I just want to raise first is, what costs should you look out for when you're comparing ETFs?
Sure. So first of all, ETFs, because they trade on the exchange, have multiple lines of cost, if I can call that, or levels of cost. the first cost is your access, so the cost of access. In other words, you need to actually go and buy the ETF, and you need to do so through a broker. So Easy Equities has made a name for themselves because they are low-cost, a low-cost platform. Some of the traditional stockbrokers, you could pay huge brokerage rates as a small retail investor, and they usually have very high minimums. I'm not sure if Brian wants to touch on the Easy Equity structures, but I know they're kind of selling, or their big part of their value proposition is the ease of investment and the low cost of investment.
I agree. Also having only transactional costs on the Easy Equities platform, we also stop eroding any monthly costs that you do incur with other traditional broking accounts.
Correct.
And as you say, these sort of things definitely impact you in the long run. You might not notice them over short term, but definitely come retirement, that's something you will definitely have kicked yourself for paying over. Right, we've got one or two questions coming through, so we're just going to head over to them. The first one is a question saying, in terms of pensions or retirement funding, what option do we have when deciding where to allocate funds?
Is that the...
Yes,
okay, so in terms of pension funds or retirement funding, there's a very specific regulation that relates or pertains to funding a retirement or a pension, and that's a regulation which is called Regulation 28, and basically it governs how you may invest. At a very high level, the principle is that you must have 75% of your assets local. You can have 25% offshore, and then you must have a blend of equities at a maximum of 75% again, property at a maximum of 25%, but it's considered within the same bucket as equities when together, so you cannot have equities and property combined more than 90%, and then you can have bonds and cash without limitation, but with specific limitations to the issuers of the bonds and the issuers of the money market or cash instruments. So it's quite a technical part of the investing universe, but really when you hear about retirement annuities, when you hear about provident funds, all of those funds are Regulation 28 compliant. Living annuities for the post-retirement market is slightly different, but all of the retirement or forced retirement, what we call compulsory savings, sits within a Regulation 28 environment. I'm not sure if Easy Equities has any product wraps which are Reg 28 friendly.
So at the moment on our platform, it's just the tax-free savings account. But obviously, we are always looking at innovating in different areas of the market. So I'll just keep my eyes on any correspondence and communications we do release about that.
Yeah, sure.
All right. I think the other thing, which is a question which come through, and maybe we can just shed some clarity on it, is are there any annual fees paid through to the issuers of the ETFs?
Okay, so great question. If I can scroll back for a second. I'm just being helped out here. How a fee structure works on an ETF basically is, and it's the same with a unit trust, one more, thank you, is that if you see that CoreShares top 50 S&P fee, I'll run you through exactly how that fee is broken down. So naturally, as the issuers, we need to pay ourselves to pay salaries. I work for CoreShares. My colleague Greg sitting here works for CoreShares. We have portfolio managers. We have marketing people. We buy Bloomberg terminals. We've got a lot of costs, and these funds to run are not as simple or as cheap as they would seem from the outside. So we pay all the same costs that a big active manager would pay in terms of running an ETF. So Coronation, Allen Gray, they pay the same structural costs that we do. So what we do to cover those costs is we pay a management fee up to ourselves. So the management fee on that CoreShares S&P Top 50 fund is 0.2%, which is collected by us as CoreShares, and then we pay our various service providers like Bloomberg and so on and so forth. The balance between the management fee and 0.32 is a number of things. The one is VAT, so on top of the 0.2 is VAT, and this is how all unit trusts and ETFs are structured. So this is an industry standard. So from 0.2 you go up to let's call it 2.3 to round, And then on top of that, you pay audit fees. The funds need to be audited. They're regulated and need to be audited. You pay bank charges in terms of the cash movements. And then you pay custody settlement fees over and above that. So that's where the difference comes between the 0.2 and the 0.32. So yes, absolutely, the issuers of ETFs pay themselves, but they just pay themselves a lot less than what a unit trust, an active unit trust manager would.
Perfect, thanks Chris. Quick question here, just asking if we can short sell on easy equities. The short answer is no, you can't. You can only buy and hold or buy and sell on this platform. It's not a CFD or derivative platform where you can short the markets. Right, let's just check if there are any other questions coming through. Right, so there's a question just on the S&P 500, which is just asking how closely it tracks the index.
Sure. So the S&P 500, our CoreShares S&P 500 tracks the index exactly. In other words, it buys all the underlying shares in exactly the same weights. We obviously have the costs of implementing it. So over a year, that cost that's now up there, that 0.55%, is approximately by how much you would underperform the index. So you're not going to get perfect index returns. That's a theoretical calculation or a mathematical calculation, the index. We actually have to implement the strategy, in other words, buy the shares and pay custodians and all those service providers I was talking about. And then, of course, we pay ourselves a management fee included there. So we track, the general rule of thumb is you will track an index exactly by, or pretty much you will lag the index by what the cost of the fund is. So that's why the cost is so important. I'm trying to think what else is relevant in terms of tracking the index. One query which we get a lot in terms of the S&P 500 ETF specifically is overnight, or when you're driving in the car back on the way to the office, you would hear the business reports and it'll say S&P Dow Jones or the S&P 500 is up 2%. And you'll go and log on to your portfolio and you'll see that the ETF's only up 1.5%. And that's because the ETF is priced in Rand. So what that means is that the returns of the ETF are driven by two things. You're effectively buying dollars. That's your first thing you're buying. And then the second thing you're buying is the index. So if the dollar strengthens relative to the Rand, you will get good performance. So it's a perfect Rand hedge from that perspective. And if the index strengthens, then you will get good performance. So let's use a simple example that I said. S&P was up 2% overnight, but the Rand actually strengthened by 0.2% overnight over the same period. You would expect the ETF then to be only up 1.8% because of the Rand strength. So that's a question that we get from a lot of investors saying, I don't understand why I see the S&P up 5% for this month and my ETF's up 6 or it's only up 4. You have to consider that you are also buying that dollar exposure and the instrument is priced in rands.
Perfect. I think that provides a lot of clarity there. Look, we got a question which is just obviously saying, how do we get active managers to lower their fees? And the truth is, it's difficult. They're not going to just lower them. Off the bat, they've got huge operations that they've got to cover. However, you can decrease the costs you pay to them by only having a smaller portion of your portfolio exposed to these active managers and having the remainder or the bulk of your portfolio sitting passive, because that will give you the benefits of both sort of strategies. And so that is an option. Or you can be an investor who decides to go solely into a passive investment. I mean, the choice is yours, and at the end of the day, you will then be able to calculate your investment costs on your full portfolio. Now, I've just got a quick calculation which will help you do that. And to understand your investment costs, you can take the sum of the average expense ratio, or the TER, and add any advisor fees you would pay, divided by the expected return of your portfolio. And if you do that for each portion, you can then calculate what your total investment costs are. And you can then start making these sorts of decisions.
Yeah, that's a great question. our brand CoreShares is premised on exactly what Brian's talking about. What it's called in technical investment speak is a core satellite investment approach, where to manage costs, because you cannot negotiate active managers down, you include a passive component within your active portfolio. So you say, let's say you had 50% in a passive strategy, like a S&P 500, and then you have 50% offshore. By doing that, you've already moved down your active or your total cost of investment. So that's a great question.
Exactly. Look, we don't have too many other questions coming through. Yeah, so all these options, these ETFs from CoreShares are available on the Easy Equities platform through the tax-free savings account, which would be a good first point of call if you're looking at, making sure you keep all your costs as low as possible, or then in the direct broking account. Otherwise, you can have a look at the CoreShares website, where if you're looking just to buy the CoreShares direct, you might be able to pick it up there. Right, if there's any other questions, we'll give it 5 more minutes just while Chris and I start doing the wrap-up. Chris, any other important points that you'd mention from a cost perspective?
No, I think as Brian pointed out earlier, what's important is to consider your costs and not just blindly make investments, because they can, erode your investment or your returns over long periods of time. And those costs come in a number of ways. As I said, accessing your portfolio or accessing your funds through a stockbroker. So you would consider using a low-cost stockbroker where you're saving costs, things like monthly admin fees. If you can reduce those or minimize them to zero, that's great. And then tax, not trading too frequently, and that's one of the beauties of holding a fund, is that you don't have to move in and out of positions all the time, and it's actually tax-free at the fund structure. So we, as CoreShares, can trade in and out of shares, and there's no tax implications, and so you don't feel that as an investor. One of the cost benefits of ETFs relative to normal shares is what's called an STT tax, which is a securities transfer tax, which is paid on ordinary shares. So if you had to go and buy an Anglo-American share, you'll see in your brokerage note it will say STT, and it's 0.25%. It's a variable tax of any purchase of equities. If you buy ETFs, that fee is actually waived because it's a trust structure. So all these costs are important to consider and to try and minimize as much as possible.
Agreed. Right, we've just got the last few questions that's come through. First one's quite an easy one to answer, and that is, should you consider tax-free investment even though you're, let's say, a student, and at this point in time you're not currently paying tax? And the short answer is yes, because obviously depending on the time horizon of your investment, you will be subject to tax at some point in time. So if you can invest these funds and you can be able to hold these funds for a longer period of time, it's definitely going to benefit you in the long run. There's no doubt about that.
Yeah.
And so as your first point of call, that makes sense.
Yeah. And if I can just add to that, even if you're a student and you're not paying tax in terms of being a marginal taxpayer and you don't have a marginal tax rate, there is a dividends withholding tax that is deducted from individuals immediately regardless of their tax status. So there is tax benefit immediately even for students, and the compound impact of that over long times is definitely worth having a go.
Perfect, I agree. Right, it looks like this is the second last question, or sorry, there's another one that's come through. So just one or two more left, and this is something maybe you can elaborate on, Chris. It's just, how is CoreShares lowering costs?
Well, look, we think our costs are low to start. If we just look at the S&P 500, that's the cheapest current exposure you can get to US equities in South Africa by quite a margin. The DBX Tracker US fund is 89 basis points, so it's significantly cheaper than that. And then if you go active again, it's a lot cheaper than that. And in the top 50, the local fund at 0.32%. That's actually the second cheapest ETF in the market. The cheapest is 16 or 17 basis points is an Ashburton fund. We think ours has benefit because it's got an extra 10 shares and we've got a smart capping system where we don't let any single share get greater than 10% in the portfolio. So we think that that benefit is actually worth paying for. And really, it's a scale business. You know, if our top 50, for example, and our S&P 500 collectively, we're managing about 600 million or a bit more in those two funds. If we were managing 60 billion, yeah, we could move our fees lower. But the real question is you know, where are you invested? And most likely you're invested actively, and we're significantly cheaper than active. So that's what we're trying to do to lower costs, and we'll continue to do so.
Perfect. There's a question through here from Wayne, which I'll just quickly tie off. Just asking about the difference in fees between ETFs and equity shares, and they both are the 25 basis points on easy equities. So there's no difference in what you're looking to purchase from a brokerage perspective. Obviously, it's just on the nature of how the ETFs are constructed as a product and their internal costs and getting those costs down. So when you act on them on the Easy Equities platform, the costs are exactly the same, except obviously one will give you instant diversification, which is obviously ETFs, where the individual equities will just expose you to that instrument.
If you recall earlier, we chatted a bit about core satellite investing, and saying if you've got an active manager, how do you lower his costs? Well, you could include a passive strategy like an ETF. You could also do core satellite in the context of if you've got an account with Easy Equities and you enjoy stock picking and you like spending time analyzing stocks and understanding the markets, but you're worried that you don't want to lose all your money, it's all your savings, you can actually hold an ETF as a core component of your portfolio and then select stocks outside that, and that gives you still would have a diversified portfolio. So
no, I agree.
Quite an efficient way of allocating your savings.
I agree. I think I've taken that on board in my personal portfolio. Right, so there's another question just around tax-free savings. Tax-free savings is limited to annual contribution of 33,000 per year, which you can either do as a lump sum or you can break it up into monthly contributions, and a lifetime maximum contribution of 500,000. So that should answer that question there. Perfect, guys. I think that's all the questions that we've managed to address at this point in time. If you do have any further questions, feel free to send them through to anyone in the Easy Equities teams. We'll be glad to answer them or send them on to someone who will give you some more insight. Thanks again, Chris and Greg from CoreShares. Always enjoyable. And until next time.
Great. Thank you.